Well, we've seen comfort and calm seeming to have returned to the markets for now, and certainly it's comments out of Europe that's managed to, set that kind of tone for the markets. It's one thing, the kind of commentary coming through from the likes of France and Germany that we have seen. The question is, is it still a sustainable path that we're on?
Well, I think what they're trying to do is manage the process. So from a short-term point of view, they've come out and clearly said they're going to support the markets from a liquidity point of view. So if there's going to be any uncertainty, it can be managed in terms of, for example, a Greek default or whatever. There's a lot of concern still on that. But in the short term, they're saying there's going to be no short-term liquidity squeeze like we saw with some of the French banks, where we saw them strongly off on Monday because of concerns like we had in 2008, where they cannot access liquidity. I think that they've come out quite clearly and said that they will support that short-term liquidity. The long-term prognosis, still a lot of uncertainty, and I think that's still being reflected in the markets. We've had a better couple of days, but I still think there's a lot of concerns and uncertainty regarding the long-term economic outlook.
Of course, there where coordinated policy intervention is going to be a focal point on the one hand, but also on the other, who's going to be funding this down the line? Is that a question being asked and answered effectively enough?
Well, I think at the moment it's a big political trade-off between politics and economics at the moment. I think the economic issue is that they've got to support the solution. I think politically, you see it specifically from Germany, the man in the street doesn't really commit to the story. So I think it's very difficult for somebody like Angela Merkel to try and get both sides correct. But she is getting a lot of support from the rest of the world, which is comforting for markets, certainly over the last couple of days.
Yep, but we've certainly seen that reaction filter through to the local markets here in South Africa. The JSE trading back above that 31,000 market. What are you making of current valuations on the local bourse and where we're at right now?
I think quite attractive from a share market point of view. If you look at the valuations, they're reflecting a lot of the bad news. Some of these shares are showing very similar valuations to what they were showing in 2008. So there's an element to the market saying that there's going to be another recession, double dip as they call it. But we certainly of the view that I think that's going to be avoided from policy intervention. And then the market's offering value. And I think you're seeing that being reflected in the likes of Anglo's. Some good corporate profits out of the last week. First had good numbers out, Sasol had good numbers out. I think the question from a market point of view is what's happening going forward. We think it's more than discounted in valuations, and we would be quietly buying into the weak markets. If you're looking back in history, November, December, even early part of January, February have traditionally been good periods for market performance, and we would be positioned for benefiting from that within a month's time.
So you're saying valuations right now more than discounting the risk that possibly belies the market moving forward, because it's interesting that you say that, where we've got this debate raging at the moment where are current valuations necessarily what you should be looking at, where there's so much uncertainty about that earnings potential moving forward?
Yeah, it's always difficult because we take the view you've always got to start with valuations. If you look back from a market performance point of view, where you really get hurt from a market weakness is when you're going into a period of weak economic growth, when the share market is showing very high valuations. That is certainly not the case now. And we actually run some scenarios where even if economic growth is flat, we're thinking the markets is actually still showing reasonable value on that basis. So it's obviously difficult because they have been supported by strong corporate profits over the last year or two with the liquidity injection, but we still take the view from this starting point, the valuations don't show a big slide in the equity markets from here.
Let's take a look at risks beyond just that global economic growth scenario, because you highlighted some emphasis, or you placed some emphasis on the resources component of the market. There's a lot of risk to consider there as well. I mean, many saying we're unattractively positioned in terms of our labor, labor costs, competitiveness. There's the high unemployment rate as well. You've got the currency fluctuations to consider as well. Just how much risk further on than economic global growth are you factoring in within the resources component?
I think with some of the results that you've seen, probably the biggest component is, as you say, the cost push that you've seen in some of these mining companies, and that's a reflection of administered prices. We see the energy prices, wage negotiations you talk about. It is being compensated with a weak dollar and quite strong commodity prices. What you've also got to bearing in mind is that over the last 6 months, China's actually been in a process to try and cool the economy down. So if the commodity prices are still holding up, with the market knowing China's trying to combat inflation by not allowing the economy really to run away, We think it is discounted, but they do have to manage costs, and that's across the board, because it is very difficult from a margin point of view. And we've seen them all 15 to 20% on the bottom line, and that reflects wages. And I think that's why we're not seeing labour or unemployment coming down, and that's a global phenomenon that's of particular concern, because at the end of the day you need consumer spending to really drive the global economy, and until you get job creation, that's not going to happen.
Yeah. Let's take a look then at that growth story that's coming out of the East and beyond, what it spells for the commodities arena, because companies specifically out with results over the recent past highlighting their focus on those territories. You've had Sanlam venturing into India. You've got the likes of First Rand as well, in that space aggressively looking at China, looking at India as their next destinations to capture more growth moving forward. To what extent is that a factor you're considering when you're looking at companies specifically?
I think it's a big factor to consider, and it's broadly emerging markets. You see some of the companies also putting focus on Africa. So I think it's where they can see demographics that are allowing economic growth, the population becoming more inclusive. So companies that you don't mention, Naspers, Richemont, we've actually seen some of those results, SAB, and I think the market's giving them the ratings that they deserve, because they're seeing the benefit of the Eastern exposure. Richemont, luxury goods business, it's almost a defensive stock, bizarrely enough, and I think it's an aspirational spend at some of the East that you're seeing on those companies, and we would certainly position that in our portfolios.
What about those leveraging for the benefits of African exposure? ShopRite, the latest one to have hit the markets today, saying that it's further entrenching its position within the Mauritian market specifically.
I think it's a theme that's been talked about for a while, and we've seen the likes of Pick n Pay acknowledging their mistakes in Australia, trying to withdraw there and really going for the African route. The risk that you've got is everybody goes to the same position. ShopRite's had the benefit in the march on some of the other companies because they've been there for 5 or 6 years. Now you're going to have the likes of Pick n Pay, Spars, Woolies, all trying to compete in the same space, and you could see some margin compression, because it's not the easiest place to do business, so you do need those higher margins to compensate you for some of the logistical and other risks that are in Africa, but it's certainly an attractive market.
Your exposure to the South African markets right now, if we have to weight it, just how are you exposed to the local market?
We're overweight at the moment. We would certainly be positioned in favor of equities. We don't like the traditional bond asset allocation. We think, with interest rates being quite low, we think it's pegging that bond curve quite low. We are concerned to some degree about inflation, and if you are looking to position for inflation, we think if you're looking for income, things like property stocks are probably a slightly better view than vanilla bonds, because they've got the ability to increase those lease repayments, particularly the higher quality ones where they're going to have very low vacancies and those type of things. So we would still favour equities. Inflation's a concern, so you've got to be in the blue chip shares, and we'd look at property as an alternative, and then your cash really as a very short-term default.